Your insurance policy may expire, but liability doesn't. Lawsuits can come long after the policy has expired. Without tail or runoff cover, you could be personally liable for claims made after cancellation or expiry. Discover how these hidden protections could save your business or career from financial disaster. Hello, and welcome to Insurance World TV, your trusted guide to all things insurance. Today, we're diving into two often confused but incredibly important terms, tail coverage and runoff coverage. We'll explore what they are, how they differ, when they apply, which insurance policies they're most relevant to, and most importantly, how they can protect you as a policyholder long after your main insurance has ended. Whether you're a doctor, a business owner, or an executive, understanding these coverages could save you from future financial headaches. So stay tuned. This is insurance knowledge you don't want to miss. Let's dive in. To truly understand these two important coverage types, let's take a closer look at each one individually, starting with tail coverage. Here are 5 questions to help us understand this coverage. Question 1. What is tail coverage? Tail coverage, also known as an extended reporting period, ERP, or tail insurance, is a provision in claims-made policies that allows the insured to report claims after the policy has expired or has been canceled, as long as the incident occurred during the period when the policy was active. It lets you report claims after your insurance policy ends, as long as the incident occurred during the policy period. Think of it as extra time to report a claim. In simpler terms, tail coverage offers additional time to report claims, even when your policy is no longer in force. It doesn't extend your coverage period or cover new incidents. It merely extends the window in which you can report claims arising from past events. Question 2. What does tail coverage protect against? Tail coverage acts as a critical safeguard for professionals and businesses that may face delayed legal actions or claims filed after their policy ends. Without it, a gap in coverage could expose the policyholder to substantial financial and legal risks. Specifically, tail coverage protects against
1.
late-filed lawsuits stemming from earlier work.
2.
Claims related to services rendered while the policy was active.
3.
Legal defense expenses, which can be substantial.
4.
Court-ordered settlements or damages. However, it's important to note that tail coverage only applies to incidents that occurred while the original policy was in effect, not to any events that happen after the policy ends. Question 3. Who needs tail coverage? Tail coverage is especially important for individuals and organizations in professions that carry high liability risks. It is commonly used by the following. 1. Medical professionals such as doctors ending their malpractice policies. 2. Independent consultants or freelancers wrapping up their practice. 3. Business owners selling or dissolving their companies. 4. Legal, financial, and design professionals, such as lawyers, accountants, and architects, who are departing from their firms. 5. Corporate executives with directors and officers, D&O, insurance, especially upon leaving an organization. In essence, anyone who holds a claims-made policy, where coverage is only triggered when a claim is reported, should carefully consider purchasing tail coverage when ending or changing their policy. Question 4. Why does tail coverage matter to you as a policyholder? The absence of tail coverage can result in severe financial exposure. Imagine receiving a legal notice for a professional error months after canceling your policy. Without tail coverage, you'd be without insurance, forced to cover legal fees, damages, and settlements out of pocket. Tail coverage bridges this critical gap. It ensures that even after your official coverage period ends, you are still protected for incidents tied to your past work. As such, it provides a sense of closure and security, especially for professionals transitioning into retirement, switching careers, or exiting a business. To summarize, insurance protects you while you work, but tail coverage protects you after. It's the final layer of defense you never knew you needed until it's too late. Question 5. What are the benefits of tail coverage? Tail coverage plays a vital role in safeguarding professionals and businesses from legal and financial exposure after their claims-made insurance policy ends. Here's how it benefits you. 1. Extended time to report claims. Tail coverage gives you additional time to report claims that arise after your policy has expired or been canceled, as long as the incident occurred while the policy was active. This extension is crucial in industries where claims may not arise immediately. 2. Protection against delayed lawsuits. Many legal claims, such as malpractice or professional negligence, may surface months or even years later. Tail coverage ensures you're still protected from late-filed lawsuits and claims stemming from past services or advice. 3. Shields you from out-of-pocket legal costs. Without tail coverage, you could be forced to pay legal fees, settlements, and damages personally. Tail coverage helps protect your financial well-being by covering legal defense costs and settlements and court-ordered damages. 4. Ideal for career or business transitions. Tail coverage is perfect if you are retiring, switching careers and employers, or canceling or changing insurers. It ensures there are no gaps in coverage as you transition out of practice or into a new role. 5. Preserves your reputation. Legal disputes, even if unfounded, can harm your professional credibility. Tail coverage allows you to access legal defense and protect your name and legacy after you've left the profession or business. 6. Peace of mind. Perhaps the most important benefit: peace of mind. Knowing you're protected against future claims related to your past actions lets you move forward with confidence and without lingering worry. Insurance protects your present. Tail coverage protects your past and your peace of mind. Key takeaway: don't let your guard down. Tail coverage is a strategic and often overlooked component of comprehensive risk management. As professionals and business owners move forward, change roles, or wind down operations, it ensures that the past doesn't become a legal or financial threat to the future. Insurance ends. Liability doesn't. Tail coverage is your last line of defense against future claims on past actions. In a similar fashion, we now turn our attention to runoff coverage, and just like before, we'll answer 5 key questions to help us clearly understand what it is, how it works, and why it matters. Question 1. What is runoff coverage? Runoff coverage is a specialized form of insurance that provides ongoing protection for claims made after a business has ceased operations or after a company-wide policy has ended, such as in the case of a sale, merger, dissolution, or winding up of an organization. It ensures that past decisions and actions continue to be covered, even if a claim arises months or years later, after the business is no longer active. Simply put, runoff coverage extends a policy's ability to respond to claims relating to the period when the business was operational, even though the business has since changed hands or shut down. Question 2. What does runoff coverage protect against? When a company closes, merges, or gets sold, its past liabilities don't simply disappear. Legal action can be brought against former directors, officers, or the company itself long after the business ceases to exist. Runoff coverage steps in to shield against such delayed claims. Runoff insurance protects you from the following incidents. 1. Claims relating to past decisions or actions made by directors or employees. 2. Lawsuits filed after a company has been sold or dissolved. 3. Legal defense costs, which may still apply even if the business no longer exists. 4. Damages or settlements related to the company's operations while it was active. Importantly, the coverage applies only to acts, omissions, or events that occurred before the change in business status, not after. Question 3. Who needs runoff coverage? Runoff coverage is typically arranged by businesses or their new owners in the event of 1. Mergers or acquisitions. 2. Company closures or wind-ups. 3. Retirement or exit of founding partners or directors. 4. Business restructuring or downsizing. Industries that commonly use runoff coverage include 1. Professional services, law firms, accounting firms, consultancy firms. 2. Medical practices, especially group practices being dissolved. 3. Financial institutions. 4. Corporations with directors and officers, D&O, liability insurance. This type of coverage is particularly vital in protecting the legacy liabilities of the business and shielding former leaders and shareholders from personal exposure to future lawsuits. Question 4. Why runoff coverage matters. A common misconception is that once a business is sold or closed, liability exposure ends. However, in reality, lawsuits can be filed years later relating to decisions made during the business's active years. Without runoff coverage in place, former owners, directors, or partners could be held personally liable for defense costs or damages. Runoff coverage ensures that your business, its leadership, and its financial legacy remain protected long after daily operations stop. To put it simply, just because the business ends doesn't mean the risks do. Runoff coverage ensures your past doesn't come back to haunt your future. Question 5. What are the benefits of runoff coverage? Runoff coverage plays a crucial role in ensuring continued legal and financial protection for businesses and their directors, even after the company has ceased operations, been sold, or merged. It acts as a safeguard against future claims tied to past actions, long after the business is gone. 1. Protection after business closure or sale. When a company is dissolved, sold, or merged, liabilities related to its past operations may still arise. Runoff coverage ensures claims made after the business change are still covered. Past acts or omissions are not left uninsured. 2. Shields directors and officers from personal liability. Even after stepping down or after a company ceases to exist, former directors and officers can be personally sued. Runoff coverage covers legal defense costs. Protects personal assets of former leaders. Ensures compliance with fiduciary duty protections. 3. Preserves the integrity of corporate transitions. Runoff coverage makes mergers, acquisitions, and dissolutions cleaner and safer by providing legal continuity, making the deal more attractive to potential buyers, avoiding future disputes between old and new ownership. 4. Covers claims arising from past corporate actions. Lawsuits and regulatory investigations can emerge years after a company's operations end. Runoff coverage ensures protection against employment disputes, errors in financial reporting, breach of contract claims, professional negligence. 5. Enhances confidence for stakeholders. Runoff coverage reassures investors and shareholders, successor companies and acquirers, former employees and board members, that any future legal challenges tied to historical activities are still insured. 6. Peace of mind for retiring founders and executives. Runoff coverage allows business owners and executives to exit confidently, knowing they won't face unexpected legal challenges down the road for decisions they made in good faith. A company may shut down, but liabilities don't. Runoff coverage makes sure your legacy and your personal assets remain protected. Key takeaway: a final corporate safety net. Runoff coverage acts as a corporate safety net for professionals and businesses facing structural transitions. Whether you're selling your firm, stepping into retirement, or wrapping up a merger, it helps preserve the value of everything you've built by ensuring your legal and financial obligations are still backed by insurance. Business may end, but liabilities can linger. Runoff coverage makes sure you're still protected when the unexpected surfaces. Secure your peace of mind. Speak to your insurer about runoff coverage before your next big transition. While tail coverage and runoff coverage may sound similar, and both address post-policy claims, there are key distinctions between them. Understanding these subtle differences is essential for choosing the right protection based on your role, industry, or business structure. Here are the differences. Tail coverage applies to claims-made insurance policies and is designed to provide protection when a claim is reported after the policy has expired or been canceled. It is typically purchased by individuals to extend the time allowed for reporting claims related to incidents that occurred during the active period of the original policy. Runoff coverage, on the other hand, applies to company-wide liability policies and is triggered when a claim arises from actions taken by a business that has been sold, merged, dissolved, or wound up. It is typically arranged by the company itself or the acquiring entity in the case of a sale or merger to ensure continued protection against future claims related to past operations, maintaining the same level of cover as was in place before the transition. Before we close, let's do a quick recap of some key insurance terms we've covered in this video. First up, claims-made policy. This type of policy only covers claims that are both made and reported while the policy is active. If the policy ends and a claim comes in afterward, you're not covered unless you have tail coverage in place. Next, we have the retroactive date. This is the earliest date your insurance will go back to cover any incidents. If something happened before that date, it's not covered, even if you have a valid policy. Now, let's talk about tail coverage, also called an extended reporting period. It doesn't cover new incidents, but it does give you extra time to report claims for incidents that happened while the policy was still active. Think of it as a grace period after your policy ends, perfect if you're retiring, switching careers, or closing down your professional work. Then there's prior acts coverage, sometimes called nose coverage. Instead of extending the old policy like tail coverage, this adds your past work to your new policy, covering old incidents under a new agreement. It only works if your new insurer agrees to include those prior acts. Another important one, runoff coverage. Unlike tail coverage, which is usually for individuals, runoff applies to businesses. It kicks in when a company is sold, shut down, or merged and covers claims made afterward, as long as the events happened before the business changed hands. In short, tail coverage gives individuals more time to report claims. Runoff coverage gives businesses continued protection after closure or sale. And prior acts coverage allows a new policy to pick up past liabilities. Here's the bottom line. Insurance protects you while you work. Tail and runoff coverage protect you after you stop. If you're thinking about retiring, changing insurers, or winding down a business, talk to your broker about the right protection. Because when it comes to claims, timing is everything. So, there you have it. A deep dive into tail coverage and runoff coverage. Whether you're a professional transitioning into retirement or a business owner navigating a merger or closure, these types of coverage offer you one last layer of protection when your main policy ends, but the risks don't. Remember, tail coverage protects individuals after their policy ends. Runoff coverage protects businesses long after they've shut their doors. Don't wait until a claim catches you off guard. Secure your legacy, protect your past, and most importantly, stay insured. If you found this video helpful, don't forget to like, subscribe, and share with someone who needs to understand post-policy protection. Have questions? Drop them in the comments. We're here to help. Thanks for watching Insurance World TV, where we make insurance simple, relevant, and real. Until next time, stay covered, stay confident.